It probably sounds too simple, but a top quartile fund should sell at a much higher premium based on its top quartile performance, as a low quartile fund will likely sell at a much lower price.
Our research of Preqin data over the last 20 years shows that there is a much higher capital appreciation of top quartile funds also at the end of their lives compared to lower quartile funds. We see that top quartile funds tend to be underpriced in the market versus lower quality funds.
Based on current strong demand for secondaries, what we're seeing in the market is that most top quartile funds are trading anywhere between par to a 10% premium. For lower quartile funds, you might see them trading around 10 to 20% discount, unless there's circumstances surrounding that would put that into more of a distressed type of situation where you're going to see much deeper discounts that could be even north of 60 or 70%.
If you introduce the concept of fair trade in secondaries, you need to first look at what is the eventual recovery or what are the future cash flows of funds across the quality spectrum. And yet you tend to see that a top quartile fund returns about 220% of its year 8-9 NAV. And hence, when you buy an 8 to 9 year mature fund, even at the 40% premium, you could still achieve a 1.6x, i.e. about the target multiple that secondary buyers achieve. I would say a fair pricing for a top quartile fund is likely to be at a very substantial premium to NAV. And if you look at the other end of the spectrum, a bottom quartile mature fund will likely only return like 60% of NAV if you look at the last 20 years of Preqin data. And hence, a fair price on that fund would be like or maybe a 60% discount or 40% of NAV. That would still allow the secondary buyer to achieve some performance. If you look at our research on the performance of mature funds across the quality spectrum, you see that a lot of the sellers leave a lot of money on the table by selling their top funds around NAV, because these funds tend to more than double in value at a relatively late stage of their lives. They would have been much better off selling their bad funds at a discount, maybe even higher than 50% discount. It's a forward-looking economic perspective that you would need to take these decisions.